So, good morning, everyone. This is again L2E Investors, and those who have joined this time only. We have started this since last week, so we have covered two sessions already. If you want to check those two sessions, you will get the link somewhere in between. I'm going to share you that YouTube link from where you can from there you can watch those videos. So the idea is to start everything from the scratch. It happens number of times the people those are active in the share market, even they do not follow the basic ideas, the basic things. So the people those are starting now and those they are working since few years on the market, everyone should get benefited. So the idea is to start from A and go up to the Z. So this is 3.5 months program, and this program is available to you every Saturday, Sunday, 11 to 12 English and 12:15 onwards Hindi. So this is PV Jain with my senior colleague Dr. Roma Singh, and we are L2E investors. This particular segment, the today's episode is basically about basics of investing. We have talked about in the earlier episode about the basics of the different type of investing and mutual fund, bonds, everything. Now we are into this segment. We will deal everything in detail. Initially, we are giving you idea only. Then we will, as the program progresses, we will deal with everything threadbare also. So moving further. See, last time what we have talked about that how the stock progresses, how fast it progresses, and how steady. Sometimes it is very very volatile also. So this is a simple chart of TCS, Tata Consulting Services. What we have seen yesterday, there was a breakout. You can see the top of the chart here. That there's a breakout here at the top, and this May, you know that Tata Consult, if you are active in the market, then Tata Consulting Services has declared the result, and they have also declared that they are going to buy back shares of 18,000 crores at the rate of 4,500. The share is trading at 3965, trading at 3965, and the upside of almost 500 rupees from where they are going to buy back the shares. So definitely, these kind of confidence towards the company will improve the market sentiment about the share. It will also improve the idea that how big the company is, how it is doing. If you see this chart, this is a multi-year chart. I can show you here at the bottom left 2011, and price was something close to 700 rupees or so, and then it started in moving like anything, and it has reached up to 3965 from 2011 to 2021, almost 10 years, and the price has already gone up almost 5 to 6 times. So this is how that particular share is behaving. Like, this is one of the big company, one of the giant in the software segment. Now coming to the second slide, this is Bajaj Finance, and this is another amazing chart. See, I'm not going to conclude anything here. I'm not going to draw anything here. I'm just showing you the chart and how the things are changing. Just see, the price was somewhere 6 to 7 rupees in 2010 or so, and the now price is somewhere around 7,000 rupees. So it has grown up like 1,000 times in almost 10 to 11 years. So the thing is,
Sir,
please mute yourself so that nobody will disturb. Please mute yourself. Okay, right. So this is, but what we have seen, there is a difference in 2020 when there was a pandemic came to India. There was sudden fall, and then again there is a rise, and that again it's moving like anything. It's going leap and bounds and continuously moving upward. So this is how a particular stock behaves of a good company. But it may happen, the stock may not move according to your expectation. Stock may not move according to uh, mm, uh, your target, and it may give you a volatile. Uh, yeah, please mute yourself. Right, further. सो व्हाट वी हैव टू लुक फॉर, हमें क्या क्या देखना होता है स्टॉक में, हम क्या किन किन चीजों का ध्यान रखें तो जिससे संभव हो पाए कि हम सही स्टॉक चूज कर पाए. हाउ विल बी एबल टू चूज अ करेक्ट स्टॉक. द फर्स्ट थिंग इज ट्रेंड इन अर्निंग ग्रोथ. सी what is a business? A business which earns growth, which earns income, which earns profit. But say a business is earning a constant income every year, there is no growth in the business, and definitely the stock prices will remain same at the same level. So there should be a scalable business. It means that every time the business should grow, the size of the company should grow in every quarter or say every year. It may happen that one quarter is not good, one of quarter is not good, and it is not, they are not doing well. Quarter means every quarter, uh, in every 3 months, every listed company has to declare their result in the public domain, and they have to declare how much new clients they have added, what is the income, what is the profit, what is profit after tax, how many new clients they have added, how many employees they have added, everything they have to declare, and what is the total debt in the current scenario. So they have to declare everything, and from there we can get data. I have shown you last time the site of Money Control, or you can go to Ticker Tap or any other site, and you can get a clear data that how the company's balance sheet is going on, how it is moving continuously, it is fluctuating. So what we have to see in a particular stock while choosing a stock, we are talking about investing, and while choosing a particular stock, the first thing we must see the trend in earning growth. So first, trend in earning growth, like you'll see a company like what we have seen, TCS, continuous growth is there, or Infosys, continuous growth is there, right? And even there is a small growth, that should be regular, that should be a regular growth. What happens is like if we take a real estate company, what happens in some year or the some part of the year on a particular quarter, the sales are very high, they have launched a project, and because of that sales are very high, and they will earn huge amount of profit, and the next quarter there is a loss. So that is possible with different sectors. Like what happens is there are different kind of sectors, in the share market. One is real estate, another is the software, another is the bank, another is the say FMCG stock, another is the say financial stock. But different kind of companies are there, and that's why whenever we are searching for a particular stock to invest, see, very clear we are searching for a stock to invest. So first we have to go for the top down approach. Top down approach means first of all we should see which sector is ready to move up, or which sector is ready to grow. If you see a particular sector that is ready to grow, say if I will say that the digital business that is doing very good in the country, digital business is doing very good in the country means what? Like we have seen there are a number of companies nowadays that is called new age companies, like a gaming company, like a company that works on only on the website, like IRCTC, what we have seen, like Zomato, like Paytm. These companies, they work over a particular software, and the asset requirement is not much for the company. And what they do, they generally say Facebook. Everybody knows Facebook, so I must give the example of the Facebook. Though Facebook is not listed in the Indian market, but we must understand the Facebook is a software. They have created a website they have created, and say number of user earlier say 100, 1000, 1 crore, 10 crore, 100 crores, and above that also. So what happens is even there are more number of users, what they have to do, they have to increase the capacity of their website only by increasing the server, by increasing the network, by increasing the some technical part. Otherwise, no extra cost is included, right? So these kind of company, they can grow without much basic cost. Say, but in a real estate company where they need to grow, like they need to grow, they need more amount of land, they need more amount of money, they need more amount of construction. So their cost is very high. But I'm not saying that the real estate companies are not good, but these companies, the new age companies, are growing like anything, right? So this is how we will reach to a particular kind of sector. Then in those sectors, we will find out different kind of top stocks. In those top stocks, what is going on inside them, how they are functioning, how they are doing, how they are moving ahead in the market, what are their quarterly results. So we'll see the trend, how the trend is going on in the market. That is more one of the first important thing, that we have to choose a particular sector, then we have to choose a particular stock. So coming to the next slide, company's strength relative to its peers. Now you have chosen a particular company, say you have chosen a X company, or you have chosen a say TCS. Now what happens is, you have to compare this particular company with peers. Peers means those companies, those are uh, doing business in the same segment. Like if I say TCS peer is Infosys, SCL Tech, Dixon Technology, and so many. Business is not exactly same. They are in some different kind of uh, softwares, but they are doing almost same business. Otherwise, you will say DLF, you will say uh, other real estate companies, including uh, so what happens is, this kind of business, so we are comparing ITC with HUL or say any other FMCG company. What happens? These kind of comparison gives you the idea of what is going on a particular sector. And while comparing, you must see that what is the total sales of the company. If possible, you should note it down. You should note it down. So it will be easy for you, that what you have to check. You have to check what is the total sales of the company, how much is operational profit, what is profit after tax, right? And what PE that market is giving to these companies. See, very important thing, we'll talk about PE later also, but I want to clarify here itself, you should compare a software company's PE with another software company only. You should not compare PE of the software company with a real estate company, or a steel company, or a metal sector company. So these are altogether different businesses. So we should compare apple with apples only, right? So we should we should start seeing all these data. So this strength, the company strength to its peers, means how much business a particular company is doing, how much business is still available with the pipeline, and how they're performing. The comparison, how they're performing in the recent past, say 3, 4, 5 quarters, the last 5, 6 quarters, how they're performing. It may happen that one particular quarter get some fluctuation due to some um, extraordinary thing, that is okay, but overall trend, overall strength should be strong, right? So what happens is, a particular company has economic mode. Like if I will say IRCTC, like everyone knows that IRCTC, we book ticket from there, and that is the only website or the only platform where we book our tickets. Even you'll go to any other booking app like Make My Trip, finally that will land into the make IRCTC, and they will book your ticket from there itself, right? So what happens is, because of that, that is a monopoly business. Monopoly business means nobody else will enter into their area, and this is the only company who will sell ticket in India. So what happens? The IRCT is not selling railway tickets; they are selling air tickets, they are selling food, and they are into other businesses also. If this kind of company is there, what happens? If this kind of company is there, they will grow like anything, right? Because there's no competition at all. So this kind of economic mode is available with IRCTC, or sometimes a particular kind of software technology available with a particular company only. So this kind of benefit will give them edge. Again, I want to clarify another important thing. What we have seen recently, the Zomato sales. Zomato is one of the company everyone knows, I think, that delivers the food door to door. And important thing is that company is still in loss, right? But market is giving them a good valuation, and that is growing very fast. Why so? Because the market do not look only into the present. Market looks into the future, how the company will grow in the future. So what happens is, in India, the food delivery market may grow from here at least 20 times more. If that food uh, delivery business will grow 20 times from here, what will the size of Zomato? Another important thing is, earlier they have started giving discount, free delivery, and what we have seen since last 15 days, Zomato has started charging huge amount of delivery charges, and the discounts are almost nil. And because of this, definitely they will go into profit. Once they will go into profit, right, and their business will become uh, start multiplying like anything, the price of the share will start shooting like anything. So in that particular hope, the people are started buying Zomato. In fact, it happens like that. Why they give discount? Why they are running their business in loss? Because they want to capture market. Say once they will start giving discount, once they will start giving free services, what will happen? More number of people will join their app. More number of people will start buying from there, and that will be the only company that will become the only company which enroll most of the restaurants, and that will grow. Like why we use Facebook or why we use WhatsApp? It is not like there is no better website than Facebook, or there is no better app than the WhatsApp. We know that we can include more number of people with Telegram. But why everyone uses WhatsApp? Because more number of people, you know that more number of your friends are using WhatsApp. If you want to join with your family, friends, then more number of people can join you with the Facebook. They will be able to search you there, right? Another app which may have a better software, which is but but they but that particular software or that particular website may not give you that particular kind of help to find your friends and post there in those websites. That's why everybody searches for those kind of platforms, those kind of websites where more number of people are available. Like we use LinkedIn, we use Facebook, we use WhatsApp, but less number of people use Hike, less number of people use Telegram. Otherwise otherwise everyone knows that in Telegram their number of facilities are more, right? So this is how a particular company become famous, and that become profitable in later in the period after say 3, 4, 5 years. So Zomato has a target that they will become profitable after 5 years. I'm not saying that. I'm not suggesting any stock. Another thing, I'm not giving you guarantee that Zomato will become profitable after 5 years. But only thing is that is how the market gives valuation to a particular stock, right? Coming to the next slide. This is very important term, and some of might you have heard about that PE ratio, right? So how does it work? This provides market value. The price to earning ratio, say a particular share is of 100 rupees, and their earning per share, the earning of the company is 10 rupees, and the value that market gives to that particular share is 100 rupees. So P by E ratio is 10. 100 divided by 10 is 10, right? The ratio of the valuing a company that measures the current share price relative to its earning per share. The price to earning ratio is also somehow known as price multiple or the earning multiple. Uh, you won't believe that in some of the shares in the American stock market, the PE ratio is 6,000, right? And some of the shares in the Indian stock market with the PE ratio is 0.6, 0.7. It means the price of the stock is not actually that particular stock is earning in a particular session, right? So it all depends upon the kind of business and how the market gives the value to that particular share. The people say that P ratio will give you a kind of analysis, the kind of analysis to investors that the share is cheaper or share is costlier, right? If I'll compare the share of a particular sector, say software sector, the generally the P are very, very high because they know that the future is bright and the market gives much more valuation to those companies, and the P is somewhere around 40, 60, 70. Those kind of Ps are available. But you'll come to a steel company like Tata Steel, SAIL, the P is 3 to 6. So there they see that the growth rate will be slow because again that the basic cost in case of software company, they are having their some little amount of infrastructure and they are having the resources, the software engineers those are working there. Not much cost is there, but in a steel company there is a plant and the value of the plant is continuously depreciating, right? While a real estate company, that is a different thing. What is going on there? The initial cost is very, very high, but even land that is there with them, that cost of the land is continuously, that price of the land is continuously increasing. So different sectors are having different comparison. So P ratio is something that may give you a correct idea. You will read it correctly. Otherwise, it may give you a very false idea also. How? Say a particular company, a Zomato. Again, coming to Zomato, Zomato is giving you a negative PE, where what we are able to see that Zomato is not earning. Basically, they are losing money, right? They are losing money, and you think that the P, why I should buy that company? Because they are actually losing. But what about if the next to next quarter, Zomato will start earning, say, 40 rupees or the 50 rupees per share? 40 or 50 rupees per share will give you what? Will give you a PE of only 3. So market always looks to the future. So that's why there is practice in the market now. The people start looking to the future PE, how the price to earning ratio of that particular company will be evaluated in the future, not now. So a PE, in the PE, if they say E, that is earning will be small, the PE ratio will be high. If the earning will be more, PE ratio will be less. So comparing to similar companies, the PE the company who is having less PE is a good company in general, right? But it depends upon company's directions, company's guidance also, right? Coming to the next slide. This is very important. Price to the book value, right? That is PB ratio. Companies use the price to book ratio to compare the market capitalization to its book value. Now, what is book value? Book value means, say, I'm going to shut down company now, right? I'm going to shut down a particular company now, and what should be the value that I'm going to get from the market? It means whatsoever the earning that I have already done, that will be collected by me. Whatsoever the amount of loan that I have taken, I have to pay back to the those people. From there, I have taken money. So that is total book value, the total asset value of the company. And that particular asset value per share, right? That is known as book value. And there is a price of that particular share. So price upon book value, that gives you the idea about the P by B ratio. Definitely P by B ratio is less. Definitely that share is good, and the P by B ratio is high, then that share is costly. I'm not saying that is not good, that share is costly. So it always depends upon what is the book value. But again, coming to the crucial point. The crucial point is that, again, in case of real estate sector, where the book value will be very high because they are having asset, like they are having land, they are having buildings, they are having their inventory, the number of flats those are lying with them, and that gives them very high book value, and the price that market gives may be less. Come to a software company, or a new age company where Zomato is an app only, very little amount of asset, very little number of offices, so their book value will be very less. But the price of the share is, say, somewhere around 156 or the 160 rupees, right? So that particular book value of the company, will become, say, Vijay, this here the price of the market price. We are talking about market price for the P, and the book is the book value that according to the balance sheet of the company we are talking about, right? So this is how that P by B value we calculate. But say what I was talking about, a software company where the P by B may look very high, but we know that business is like that, where that their asset is very, very less. Their asset is not actually the building. Their asset is not like that you can value. Their asset is those kind of intellectual property that cannot be, that is not tangible actually. So that's why the P by B ratio in case of software companies are very, very high. So while choosing a particular share, you have to be very careful on which sector you are. You should not compare that P is very high or the P is very less here, or the PB is very high or the PB is very, very less. It depends upon the sector. It depends upon the growth guidance of the company also, right? So key takeaways from the P by B. The P by B ratio measures market valuation of a company related to its book value. The market value of the equity is typically higher than the book value of a company. Generally, P by book ratio is used to value investors to identify potential investment, and P by book ratio under 1 are typically considered solid investment. If the book value is more and that price of the share is less, definitely in that case you should invest in that particular company. If that is not a loss making company and the prices are that book value will further not go down. If that is making profit, then that is a very, very good investment, right? Further, how the company that treats dividend. See, in share market, there's one term that is dividend. This is for the basic investors. So I must explain dividend also. Dividend is what? Say a particular company after every quarter or after every financial year, they calculate how much profit they can distribute with their investors, right? It is not always a company say earning 100 rupees per share. They will share whole 100 rupees with the investors. Definitely company wants to grow. Company wants to put the money, profit money again in their business to grow further. And that is actually a correct idea. If the company is having greater idea, their company is doing fine, the company's management is having vision, definitely they will try to invest more and more amount of money in scaling up the business instead of uh, giving the dividend. So what happens is a dividend is one thing that company provides to their investors and quite consistently. Like if you see almost 4,000 rupees stock, TCS has declared the dividend of only 7 rupees, right? While what we have seen in the recent past, BPCL has given the dividend of 57 rupees per share. The share price is somewhere around 395 or 396 rupees. So dividend is something that the company decides to share with their investors. And generally, this is the notion in the market. The company provides regular dividend. It means they are generating profit, and because of that, that share is good. But that is not always correct. A company that never gives good dividend, that is also not good. But a company provides regular dividend of a minimum size, that is, I think, good, because the company is growing very fast. In the share market, we do not invest to earn for the dividend only. Okay, dividend is extra benefit that we get, right? But a share which gives you multiple growth, say the price increase like anything, that is much more beneficial than earning that dividend of a penny size. So instead of going for the dividend, we should look dividend as how the company is doing. They are providing regular dividend. It means financials are good. This is the only idea that we have to draw it from here. So effectiveness of the executive leadership, that is again very, very important for while choosing a company. How? Say a particular company is having a very good management, right? Where the very good vision is there, and leadership is having that kind of quality. They are having the experience. They are having a kind of culture in the company, and they know how to start innovation in the company. The company is flexible in the different products. In those cases, the company can move much faster. Like what we have seen in the case of some of the companies like Just Dial. Once the management got changes, they have got different kind of vision. New people entered in the company and they started producing more and more profit. If they have started producing more and more profit, it means That is not only because the company remains same, the management's vision that quite changes, and because of that, they're able to generate huge amount of profit. So this is how management can change the company. In fact, there's another very important area that we call corporate governance. Say, company is preparing their balance sheet. There are auditors also, but this is the crude fact in the market. There is number of problems related to corporate governance, especially in India. The people they create false balance sheet. They do not show the proper profit. They take out the money for the different other purposes. Say a particular company earning huge amount of growth, and they are investing that amount of money to scale up the business, to earn more business, to new ventures, these kind of things. But another company, they are buying private jets, they are buying different kind of other things that is actually not producing items, right? That is kind of luxury for the company, right? In that case, the company will definitely not grow, right? And company are sitting like what we have seen in case of ITC, that is ITC is one of the very famous share in the stock market, and that rarely grows. And the problem is the company is lacking the vision. They are having huge amount of cash. They are generating profit also. They have 60% cigarette business of the Indian market. In fact, the world market, they are also having the huge share of the cigarette business. But the thing is, they are not able to deal with their cash, right? They're not able to start a new vision, right? And what we have seen in the cigarette business, there is continuously the kind of environment that is getting created against the cigarette, and because of that, ITC is not growing. They almost a stable share, and the people, those are ITC investors, they are sitting with the same amount, the same price there itself, right? This is how management or leadership can change a particular company. In fact, in any company, if you find that there is any issue related to corporate governance that comes into the eye, believe me, you should exit from that particular share immediately. What we have seen in Yes Bank, what we have seen in Satyam Computers, and what we have seen in some other companies, I do not want to take name of those companies. We should take out our money and we should invest somewhere else. See, share market is already having 8,000 shares, more than 8,000 listed shares, and they and we should not stick with one share only, even we are losing our money. We should invest our money in those instruments where we can earn more. Right. So the next thing is long-term strength uh, of the company and its stability. What we have seen the company, the number of companies that comes to the market, and have you heard about one of the company of the Vijay Mallya Air, right? That came to the share market with the bank, and they started business like anything. And what happened suddenly? That company started generating loss, and that company is now having zero value, right? The huge amount of debt in the company. You know what happened with the Vijay Mallya, and because of this, the investors' money got eroded. It becomes zero. Those people, they were mature, they came out from the fair early, but the rest of the people, they got stuck there, and the value of their money becomes zero, right? So this is the nature of the stock market. You will get very very good companies, you will get very volatile company, you will get a very uh, stable company, you will get a company that is growing like anything. What we have seen in the first chart of the TCS is growing continuously. Tata is one of the management that looks very, very good, and with their culture, with their uh, business idea, they are doing very good in every field. Now, how you go for a company? Like what happens is you get up in the morning and you start using different items. You use toothpaste, you use shaving cream, you use soap, then you start eating, then you take your vehicle and you go to your workplace. There you also use number of different items. We must see all those things with the open eye that what are the products that we are regularly using, we are paying for that. Actually, those are the companies where you are paying money, and you must get those shares in your idea, right? You should check the valuation of those shares. You'll check all these parameters of those shares. So you'll come to know like what happens a particular product. I must say, everyone uses Fevicol in the day-to-day business, right? So Fevicol comes from Pidilite, and how the Pidilite is doing. And the Pidilite is not having only one product; they are having number of products. They are also famous for their creative advertisement and number of things. And they are almost having the control over their market, right? They are the biggest player in that particular market. That's how we choose a particular company, right? And then once we'll reach to the particular company, then we'll go to those parameters, that P by E, trend, the profit and earning, the total debt of the company, that we will see all those things later on. So here are some of the important things, 7 things that investors should consider when picking a stock. Trend in earning growth that we have seen, company's strength related to its peers, debt to equity ratio in line with the industry norms. That what happens is, I have told you that debt to equity ratio in case of the company which is a software company, the debt will be less, but in a case of real estate company, they take money from the market, that will be high. So we should not consider if the debt is high in case of real estate company to compare to a software company, then that software company is good. Definitely, the nature of business is different. In case of real estate company, that will remain high, right? Price to earning ratio, that is PE ratio that we have seen, and we have to check that PE ratio in a correct manner, right? And how company treats the dividends, and effectiveness and executive leadership of the company, and long-term strength and stability of the company. That is again very, very important, right? So coming to the next slide, and this particular slide belongs to Dr. Roma Singh, and she will continue from here.
Thank you, Priyansh. Thanks a lot, and good morning to all. So Priyansh is today telling about investing and how we can choose, how we can check parameters for investments. What I can summarize here, that you can choose a growing business with monopoly. If it is with monopoly, it is very good. And then you can check these parameters. You can check their past performance. So we are not suggesting anything, because we want you people to go through these charts, these stocks, and everything we are telling you slowly. And we'll again, Priyansh will tell you how to see charts, how to see different portals for checking growths of these companies. What I want to tell you today is that because we people are here because we want to earn money. Money gives us very good strength in our lives. And the successful traders get these things. These are the advantages of trading, like time liberty. You may do trading or investing anytime. Anytime means it is not necessary that you fix some particular time. Whenever you have time in a week or in 15 days, you should invest that time to find out what is good for you, what is good for your money, where to put your money. It is better you check on your own and do not give this liberty to others, that you earn the money, you earn it, and then you invest it on somebody else suggestion or guidance. So it is an advantage that you take your liberty and you decide whenever you are having time. So this is the advantage of this thing. If you are investing on your own, you can take your liberty, time liberty, you may decide anytime. But yes, you should check it every fortnightly, at least every 15 days. You should check where you have kept your money, how it is growing, how it is working. Then space liberty is there. In office, if you are having time, you may check it. At home, you may check it. If you are doing nothing, only managing your money, then you can work from home. Financial stability comes with money. And if you are investing it properly, then you will see yourself that you will get liberty and you start earning very good amount of money with your initial capital. Then it gives independence also. Once you raise your capital, then you can work from home and you can leave your job. So there will not be any boss. You will be your own boss. You can decide your time, your space, your working atmosphere, anything. So it gives you one more thing is there, that if you are investing with proper guidance, with proper study, then you can get a very good wealth creation. And one thing more I would like to add here, that if you are investing money in stocks, then you need not to pay 30% of your tax when you are in higher tax band. On long-term capital gain, it means if you are selling your stocks after 1 year, it is only 10% on your income. So it will also give you very good edge over your over any other business, because in all other businesses you have to pay around 25 to 30% taxes in higher tax band. But here, no matter in which tax band you are there, you need to pay only 10% of taxes. Then one thing which is very necessary while you are going for investing is that you acquire those qualities which are there for a successful investor. What are these qualities? These are, the very first quality is self-discipline. What is there, that there are so many videos on internet where you can find different techniques, different tricks to earn money, but nobody of them tell you how to stop, where to stop and where to start things. It means the discipline is to do nothing when there is no opportunity. It means that it is not there that everybody is saying, yes, market is going high, it is very good time, you should buy. And you have selected some stocks in which there is no growth is coming right now. Or you are seeing that, yes, I have invested at that time in Wipro, but it has not increased till now, so I should come out of it. And Wipro is at the point of breakout at that time. So you should check according to your rules, according to your regulations, not follow anybody else's guidance at that time. If you have very good track record of things, you are following certain stock for a long time, and it is about to give you result, then don't come out of it. So this is called self-discipline. You have to be in discipline if you are working in this market, because we have to follow the market trends. There are trends in market, and once you will be sitting with people for some more time, you will come to know about these things on your own. There is a technique through which you can learn to watch these stocks, and once you will be watching them seriously and sincerely, you will come to know that yes, these stocks are following trend, and according to these trends you have to decide for your opportunities and for your exit and entry points. So this is the same point of patience is there, that exit and entry points should be taken care of. Whenever the stock is going up, you have to take entry. Whenever it is supposed to go down, you have to exit. But in that case also, you will have to watch about the primary and secondary trends. So there are two types of trends, primary and secondary. We will be discussing them later on in later classes. Priyansh will tell you accordingly. And then you can decide on your own. Then adaptability is there. What is adaptability? Adaptability means once you decide about your strategies, you should you can adapt any new strategy if you find that is more suitable according to the trend. And you can leave some strategy if you are finding that you are not making gain through it. So adaptability is very important for a trader, and market is changing. It is not depending on your strategies. It is depending on a collective emotions. So adaptability should be acquired there. Then again, there is mental toughness. What do we mean by mental toughness? Once you decide, you should stick to your decision. And it is very important because market is very volatile. As Priyansh has shown you two graphs there, at the time of Corona, some stocks came down. Almost all stocks came down abruptly. But you have to wait, you have to keep patience, because all those stocks are on their double level right now. So if you might have come out at that particular time, then there would be a loss for everybody who has come out and didn't again buy, because you cannot decide on your own the levels. It depends on market and collective emotions. So for that, we need to watch the market. We need to have patience. We need to have a mental toughness. Once we decide, once we plan, we make our strategies, and we keep certain things in our mind, then we'll have to stick on those points unless and until we find something very good in comparison to that. And investment is very important when we consider these things in our mind. Then forward thinking means that we try and test things in market. We choose some strategy, try these strategies and adapt them. Again, if we find that trend is different, then according to that trend, we have to test our strategies, select them, and move forward. So this is called forward thinking. According to market and trends, we should move forward. Thank you, Priyansh.
Okay. Hello, guys. So thank you, madam. And further, I want to tell you how we choose stock in the share market, how we buy stock in the share market. Somebody will tell you, your friend, buy this stock that will grow like anything. And what happens? We simply buy that particular stock. But same thing even not happens with the vegetables, right? You want to go to buy vegetables, and vegetable wala will tell you this is good vegetable. You just check it on your own hand, and then only you buy. So if you do the same thing with the 20 rupees of the vegetable, why don't you do the same thing with the your stocks? If you'll start checking that with the trend, with the business, with the P ratio, with the PB ratio, with the balance sheet, and how the business is growing. What is the vision of the business? Definitely, we are going to choose a very, very good stock. Say, it happens like you say that I'm not having any idea about the stock market, how I can buy a stock. Then we are here to teach you from ABCD till Z how to choose a particular stock. We have started, and we are going to tell you step by step. But the important thing is you should not listen to a particular TV channel and start buying a stock, right? Otherwise, you should not go for a Telegram channel and start buying a stock. What we have seen recently, what happened the day before yesterday, 7 people from Gujarat, they got jailed because what they were doing, they were suggesting in a particular Telegram channel where thousands of people were there. They used to suggest a particular stock after buying that, and once people started buying that particular stock, that started growing multiple times, they usually sell their stock, and by this method they have earned 325 crore rupees. So this kind of practice also going in a stock market, but it's not like always that does not happen. You will buy a good stock with your study, with reading the financials, with reading the vision. Like you will buy a particular good company stock, blue chip stock like TCS, Infosys. There is a multiple group. I'm just suggesting the name. I'm not saying that you should buy these stocks, right? You'll buy these kind of stock. You can check yourself that how they you can buy any point of time in the 3 years, 5 years time period. You'll grow that. You'll find that they will grow to double in 3 to 4 years, right? So if you know how to check a particular stock, then you know how to buy a particular stock. If you're having any kind of doubt, then you can go for the back test. Go to the previous data, check those stocks, and assume that you have bought that particular stock, and then see in the future how that is behaving. Otherwise, you can do with the present time also, but you have to be patient. You can buy a particular stock on paper. Say you wrote that I have bought that particular stock on paper on this particular price, and after 1 month, 2 months, 3 months, 6 months, how that particular stock is behaving. It is behaving like according to your study or not. That is important. So what you have to do is you have to be very careful while choosing a particular stock. And once you'll get experience, you'll be able to choose a particular stock quite easily. Another important thing, I'm warning you. What happens? Usually, the new investor comes to the market just after the corona. Number of investors they came into the market, and in the market you'll buy ABCD anything. What happened during the period of corona? that started growing in the multiples. And generally, in that particular time, we are having that kind of a notion in the mind. Now I'm a pro, I can buy anything, and whatsoever I buy, that will grow. That does not happen. That is by chance only. And usually, these kind of investors or these kind of traders, they buy certain small quantity of something and they get profit. But once they in the greed starts buying a large quantity, they get huge amount of loss. And that is a proverb in the stock market. First investment of every investor goes into win. But believe me, that is not correct. If you will go with the study in the stock market, will start reading everything, right? You will be able to grow your business, grow your money, like anything. So try to understand this that thing. If you're going to buy a particular stock from any of the company, actually you're buying that particular business. You are the owner of that particular company. So what kind of business you like, where you think that there will more amount of profit, more amount of stability, more amount of growth, you should buy those shares. So this is very very important. I have given one link in the chat box. That is our YouTube channel link. Those have not seen the first two sessions of this particular video, this particular session, this Zoom session, that is recorded videos are there on this particular YouTube channel. Please click this, and you will land into that particular channel. And from there you can again, if you say you have not attended the first and second session, you have directly coming to the third session. In that case, you can choose, you can go through those lectures first, then come to this. We are going to upload this particular video also after some time, so that will be also available with the name of third session. So please go through the first and second session. And another important thing, those have joined late, are they want to attend the same session in Hindi, we are going to continue the same session in Hindi from 12:15 today itself. 12:15 पे हम सेम सेशन दोबारा करेंगे हिंदी में भी, और उसका भी लिंक अभी जहां से आपको मिला मैं दोबारा वहां पर अपडेट कर दूंगा. So you can join the same session again. Now I'm inviting questions. If somebody is having question, please ask. You can unmute yourself and ask questions.
Hello, sir. Can I ask a question?
Yeah, sure.
Sir, I want to know about the P ratio and PB ratio in little more detail. Can you explain that?
Yeah,
again?
PE ratio is very simple. How much a particular share is earning, that price of the share is there, P is there, price of the share is there, that is price. If you divide it by the earning of the share, then that is PE ratio. If you divide it by the book value, then that is a PB ratio. Book value is the value of the asset of the company. That is, say, if I want to sell a particular company, it's going to roll down the business, and what is the value of that particular asset of the company, that is the B, right? That will divide into the per share basis, that is P by B ratio. And the P by E ratio is the earning. So if the earning will be more, P ratio will be less. If the earning will be less, P ratio will be more. So the earning is more, P ratio is the less, then it means there is that particular stock is cheaper. But it depends upon, again, I have explained you what kind of business that is.
Thank you, sir.
Okay, right. So I hope tomorrow we are again going to start at 11 with the English and 12:15 in the Hindi. So those they want to join, they can join again. And this particular channel will also have the video. Please click that particular link that is given in the chat box, and to continue from there. From today's class, this is all from my side and from our side, and that is topic for tomorrow will be, you suggest what kind of topic you need, Vijay? Our idea is basic investment that we are going to teach you initially. Tomorrow, my idea is to show you the graph. Trading will be little early, Pranav. Tomorrow we'll start with the investing chart. what kind of, see what we have seen, the fundamental things of the investing today. Tomorrow my idea is we should go for the technicals of the investing. You may get little idea about trading also, right? Yeah, sure, some chart analysis, definitely. Why not, Vijay? Definitely, sure, right? So on this note, I'm ending this particular meeting. Those they want to join Hindi, they may continue with the next link. Happy investing, guys. Thank you.